Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy will impact your bottom line. I'm your host, Akiko Fujita. Now, as a candidate, President-elect Donald Trump laid out a slew of tax proposals, including a promise to make his 2017 tax cuts permanent. Last week, Trump appointed billionaire hedge fund manager Scott Bessent as his Treasury Secretary. That was before he put out a new proposal on tariffs for U.S. imports coming in from Mexico, Canada, as well as China. Now, with Bessent now poised to lead the Treasury Department, the question is, can Trump implement these tax reforms, and what impact will they have on the economy? We'll dive into that later on in the show with Garrett Watson. He is Senior Policy Analyst and Modeling Manager at the Tax Foundation. But as always, we begin with our co-stars, Rick Newman and Ben Werschkul. Ben, what do you have on your note cards?
So what I have got, don't call it a comeback, but I have got the return of Tariff Man, Donald Trump's return of tariffs. So the headline here is that he's going to do, the president-elect is promising 25% blanket tariffs on Mexico and Canada and new 10% duties on China. That's in addition to any additional tariffs he wants to do later on. So it's basically just a kind of re-underlining of what he talked about the entire campaign of his tariffs. The stated reason for this round is drugs and illegal immigration. And he's basically, but it's about to set off a whole chain of diplomatic and legal back and forth. It's going to probably continue all the way through Inauguration Day. Mexico's already talking about retaliatory tariffs. There's expected to be some sort of concessions offered. And the question is whether Trump kind of takes a win here on small measures, or he kind of goes through with this. And if he does go through, it's a whole lot of legal questions that kind of come ahead. We're all going to learn about things like the International Emergency Economic Powers Act of 1977, which is the way he might do this sort of thing. That's what he's expected to do. So it's a kind of complicated picture that's going to play out for a long time that he kind of set the starting gun on this week. Rick, how do you see it playing out?
So does anybody know what Trump has against Canada? I mean, what is he going for there? So Mexico and China he's picked on them. He picked on them a lot the first time around. Of course, we know he already did a round of tariffs on Chinese imports, and those are mostly still there. Biden left those in place. Mexico, Trump obviously has grievances with regard to all the migrants coming across. I mean, I don't really know what Canada. I mean, I don't think too many migrants are coming in from Canada or fentanyl's coming in from Canada. But Trump wants some leverage. I guess he's going where the money is. Those three countries are the top three U.S. sources of imports to the United States and our largest trading partners overall, which means we also export a lot of stuff to those countries. So this is going to be interesting. But you know, I'm detecting a more subdued market reaction this time around, and maybe for a couple of reasons. First of all, I think we know by now that Trump tends to threaten a lot worse than he actually ends up imposing. And everybody seems to have gotten used to the idea that this is all part of some kind of negotiation. He wants something, so he goes and he threatens tariffs, and then we'll see if he gets anything he's after. One other thing, I'm just really intrigued that voters don't seem to care that much that Trump wants to basically raise the cost of goods they buy every day. I mean, that's what tariffs do. And there was some insight in this from new research from Morning Consult. They just did a poll asking people what they thought about tariffs. And I'll just put out one of these findings. I've written about this week. But the one finding that I thought was really interesting, they asked people, what do you think a tariff actually is? And they gave them four options. And only 25% of people correctly said that a tariff is a fee that an importer in the United States pays to import a product. 60% thought that either the foreign government or the foreign company importing the product pays a tariff, and 15% said they didn't know. So only 25% of Americans even know what a tariff is. So I guess maybe that explains why people don't seem to mind if Trump actually plans to do this. Now, if this actually raises people's costs, they will. But I think Trump is going to be pretty crafty and maybe make this happen in a way that people don't actually see.
So a few things there, Rick. I mean, you know, the question about what does this mean for the average American consumer? There's a number of studies that have been out there. The Yale Budget Lab has one of the highest estimates. They talk about more than $7,000 for an average household if these tariffs do go through. And that's not even including Mexico and Canada. But one of the questions I had, you know, you mentioned the market reaction a little more subdued. And that is yes, because I think all of us are having some flashback to 2016 to 2020 when we did constantly hear about these tariff threats. There is a USMCA in place, a free trade agreement between Mexico and Canada, which, by the way, was renegotiated as NAFTA 2.0 because of Donald Trump. What does it mean for that framework if, in fact, can he impose tariffs when there is a free trade agreement in place already between the U.S., Mexico, and Canada?
I mean, so I'll give a short answer and then let Ben. Ben, I hope you've brushed up on your trade expertise. You can explain all the details. So the short answer is Trump doesn't care if he can actually do it or not. I mean, you know, one of the famous questions from Trump's first term is, can he actually do that? And the answer to that question is he can certainly try. So Trump tried to do a lot of things that it turns out, yeah, some of them he can do and some of them he can't do. So, I mean, Trump doesn't mind breaking things. He doesn't mind causing chaos. And what he can try to do is just impose these tariffs and then let it litigate. Let everybody make their claims. And I don't even know what the judicial mechanism is here anymore, because I mean, basically the World Trade Organization is out of it and was kind of, you know, somewhat toothless anyway. So what if Mexico or Canada disagree, but the United States says we don't care? I mean, maybe it just goes through anyway. Ben?
I think that's part of the answer there, is that essentially whether trade experts don't actually know, people that are much smarter than I on trade don't know if this is the end of USMCA if he goes through with this. I think the bottom line is it's sort of functionally the end of USMCA. If Trump goes through with this and Mexico does retaliatory tariffs, that pact is kind of on ice until it sunsets in 2026, and then it could be an opening to renegotiate. I also think, to kind of go back to your earlier point of why Canada is part of this, I think that's part of this here, is that sort of the USMCA is those three countries, and then by bringing Canada in, you kind of kickstart potentially those negotiations by grouping them all together. I think the other interesting aspect of this is that all three of these negotiations, I would think, will kind of operate on different platforms. I think China is clearly the hardest one. Mexico is also really hard. Maybe Canada, they can sort of figure out a thing. Trump can take a win there and then deal with these bigger, more challenging countries, in his view. I
read one analyst today or this week who said the report card for how Trump is doing as president is the stock market in Trump's mind. That is how Trump thinks of it. If stocks are going up, he doesn't really care what impact his policies, tariffs, or whatever. You know, the other big one is deportation. If stocks are going up, Trump's going to say it doesn't matter. You know, the country's in great shape. If stocks go down, if stocks basically say we don't like this, then that is what gets Trump's attention. So if you buy that way of thinking about it, then what's likely to happen with tariffs is he's going to play with different numbers, and he's going to see what the market reaction is. So there really is no market reaction on, you know, now when Trump has first said, well, here's what he plans to do on his first day in office, which is still almost 2 months away. But that'll change as we get closer. And back to 2018 when Trump was actually imposing tariffs. I mean, we had markets yo-yoing based on it's going to be 25% no, and now it's only going to be 7.5% or whatever. And markets, in the end, were kind of okay with it. There was a lot of volatility back then, but it was generally okay with markets. I think that's how Trump's going to play it again.
Strap in is what you're essentially saying, Rick, because we're going to see a lot of these play out publicly. Here's the other question. I mean, we kicked this off by saying that we now know who Trump's nominee is for Treasury Secretary. And this is a question to you, Ben. I mean, this sets up an interesting dynamic, right? You think about Scott Bessent and where he stands on tariffs. And then you've got Howard Lutnick, who's, you know, now the nominee for Commerce, who said publicly that he believes it can be used as a negotiating tool. How are we likely to see this play out internally if the president-elect has already put it out there saying, I want to move forward with these tariffs?
Yeah. I was working yesterday or earlier this week on a story about Bessent, and it was about the honeymoon period. It was on Monday, and then that honeymoon period ended really quickly when Trump did this. So I think Bessent is Trump's kind of firewall to a certain extent. He's the guy who's market friendly, who kind of makes markets not gives this kind of muted reaction you're talking about here. They believe that Trump can be moderated on tariffs, and Bessent's the guy to do it. The question is, to your question about it internally, when Trump is sitting at the table with Howard Lutnick, who I would argue kind of plays into Trump's instinct. Howard Lutnick talks about how the era of William McKinley was great, and it was great before we had income taxes. And you have Scott Bessent, who can kind of give a market reaction. Who wins that argument in Trump's mind? And that's the big question that we don't know yet, and we don't know who else is going to be around that table to kind of push Trump in one way or the other, whether it's towards his tariff instincts or towards a kind of more market friendly direction.
You know, Scott Bessent is basically a heavyweight. Markets trust him. Apparently, I think a lot of us don't know that much about him or what he would actually do as Treasury Secretary, but he's seen as somebody who's of the markets. So that's why you saw market buy-in. So in an actual Trump administration, maybe this will be something of a force for stability, at least economically.
Yeah, if we can learn anything from the last administration or last Trump administration, it is that the Treasury Secretary was the steadier hand in an administration that had a lot of volatility, shall we say. We're going to take a quick break here. We'll be back with much more here on Capital Gains, including our guest, Garrett Watson. We'll be right back. Welcome back to Capital Gains. We are now joined by Garrett Watson. He is a senior policy analyst and modeling manager at the Tax Foundation. Garrett, welcome. Before we ask that first question, I kind of want to defer here to Ben as the setup guy, because Ben has taken on this task of going through all the list of promises we have heard from Donald Trump, at least on the campaign trail when it comes to taxes. Then take it away.
For sure, yeah. So, Garrett, I promise I won't make you repeat this whole list at the end, but I made it a little pet project to kind of chronicle all of them, and there's an even dozen. So I'll read them really quick, and you can tell me which I can cross off forever and which I should pay attention to. So real quickly, all 12. Fully extending the 2017 tax cuts. No taxes on tips, overtime, or Social Security. Lowering the federal corporate tax rate. Eliminating the SALT cap. Tax credit for family caregivers. A car loan interest, making that deductible. Ending double taxation for Americans. A new first-time homebuyers credit, unspecified additional cuts for working class, and best for last is eliminating the income tax entirely in favor of tariffs. So take your list. What can we ignore entirely, and what should we actually be paying attention to from that?
So I think the central focus headed into next year for sure, the top priority for Congress in particular, is going to be the looming expiration of the individual side of the 2017 tax law. It amounts to over $4 trillion of tax cuts over 10 years. In our estimation, over 60% of American households would see a tax hike relative to next year if it were to expire at the end of next year. And so that's going to be priority number one. Then the big question is, how do you fit in this raft of additional tax cuts that President-elect Trump is proposing that, of course, would add to the revenue cost? There's a few different tools to think about that, right? One is a lot of the design details of these new tax cuts weren't really fleshed out during the campaign. We haven't heard a lot of detail. That's actually an opportunity for both Trump and Congress to fiddle with the design to potentially limit the revenue cost. Maybe they make them temporary over a few years to test them out, so they can balance the desire to fulfill some of the president's promises on the tax side while also trying to make the numbers work, because that's going to be the big question for Republicans. Can they get a top-line deficit number that they can live with in both chambers that also fulfills a lot of these promises? So I think that's the big picture question. And of course, the other big thing, which y'all were just talking about, is the looming specter of tariffs. Does that come into the equation in terms of the revenue? Does that make the math work a little bit better? Does Congress actually get involved? That's another big question. To what extent will that be led primarily from the executive side versus Congress? All of these are open questions right now that I think both the transition team and Congress are trying to grapple with.
Garrett, I just want to grab on one of Ben's 12, no taxes on tips. So this is a bad idea. I'm happy to say that. Analysts don't like this tip. It was clearly a sop during the campaign by both candidates to voters in Las Vegas, where there are a lot of hospitality workers. Trump did end up winning Las Vegas. Maybe that helped. But first of all, this would only help people who get paid in tips, and most Americans don't get paid in tips. It would do nothing to help other lower income workers who don't get paid in tips. There's even this idea that higher income workers could suddenly start to say, "Oh, I'm going to declare half of my income as tips, and it's going to be untaxed." So this seems like a really bad idea, and yet you see members of Congress are now introducing legislation to actually make this happen. So, I mean, can you see Congress actually passing that one provision?
Given that there is some legislative language out there, that could be a starting point. I think there's some design detail to figure out, right? One is, how do you deal with avoidance opportunities, as you just mentioned? How do you deal with whether or not there's going to be a limitation on the amount of tipped income that's exempt, or if there's an income limit? Things like that to figure out. Whether or not the tips are exempt from payroll tax is yet another question. But I think, as you pointed to, right, one big theme with a lot of these tax cut proposals is it's not clear what the policy goal is. What exactly is the problem we're trying to address? And that's probably a better starting point than starting with very targeted tax cuts that yield themselves to avoidance opportunities and complexity, and make the tax code even more of a bear than it already is for taxpayers, while also reducing revenue. So I think that's going to be a question mark there. One big, of course, uncertainty is, how hard is the administration going to lean in on these additional tax cuts? I think this is my intuition, is a lot of policymakers want to focus on extending the 2017 tax law rather than prioritizing new tax cuts that make the math harder and are a distraction. But if Trump really leans in hard and wants to see some of these things added in, it's going to be hard for Congress to resist that. So they'll have to do the hard work of filling in some of the design details if they want to move forward. Another question is, to what extent do they try to make these new tax cuts temporary? That's another thing they could do, arguing that, hey, this is a test drive. Let's try this for a few years. If it doesn't work, we can always allow them to expire. That's another option in their toolkit.
Garrett, there's a lot of questions you put out there. I mean, my big question is really the deficit, right? And you said, what is that number that Republicans can live with, top line? You've had the number coming out from the Committee for a Responsible Federal Budget, $4 to $5 trillion over the next 10 years is what they've put out. Is that a number that you think Republicans can stomach?
I think right now, as we're seeing, and this is very much generalizing, but there's a bit of a split between the chambers on this question. And that was actually an echo to, and a similar dynamic to 2017, where it appears the Senate may be a bit more interested in increasing the deficit than the House maybe. That's partly because they may view the extending current policy, that is the current tax cuts, as not being the same as creating new tax cuts. So it's a question of compared to what. So they may be more interested in a larger deficit increase in a reconciliation bill. The House may be a little more reticent on this question, especially given that they're going to have a very narrow majority, less than a 10-seat majority, compared to, I believe it was about 40-seat majority in 2017. So it only would take a handful of members who are really worried about the fiscal trajectory of this country to ask for it to be trimmed back. The big temptation and the best way they could deal with this logistically, not necessarily in terms of policy, is to extend things temporarily. So that $5 trillion number is accurate over 10 years, but that comes down quite a bit if you were to extend this to, say, 4 or 5 years. So that may be a temptation. That, of course, comes with a big trade-off, which is we got to do this whole exercise again in a handful of years, and it may not be under unified Republican control. And so that's going to be another question mark there. In our view, I mean, there isn't a lot of oxygen right now in completely redesigning or reopening all the decisions that were made in 2017. That's always another option, to try to reconfigure things a bit. But that lends itself to a lot more work and always creates the risks that you might not get enough votes for whatever that looks like in both chambers, given the narrow majorities. So I think that's going to be the primary temptation moving in, is something more temporary, depending on, of course, the offsets. I think that's the other big question, the tariffs being the biggest one. Others we've heard about, of course, as y'all may have seen, is potentially paring back some of the green energy credit expansions that were introduced in 2022 by Democrats in the Inflation Reduction Act. That could bring in upwards of potentially $800 or $900 billion. Just a partial offset, but that does make the math somewhat easier if they can get that on board.
So here's something that they may reconfigure from what they did in 2017. And this is not on Ben's list of the top 12. So let's make this maybe number 13. The SALT deduction, the state and local tax deduction, that was capped. And there seem to be enough Republicans who want to get rid of that cap that maybe that will actually happen. How do you see that playing out, Garrett? Is that a realistic possibility that the cap on that deduction goes away?
What we've seen on SALT for the last few years is there's actually been somewhat of a bipartisan interest by a narrow handful of members, particularly in the House, who represent districts where SALT was a predominant concern. Think Republicans and Democrats representing a lot of districts in blue states on the coasts where SALT was very much binding for upper income households with high property tax bills and state income taxes. And so with this electoral result where you have a handful of Republicans representing the majority in the House, that means I think the pro-SALT caucus has some leverage here to ask for something. The missing piece has always been, is there a compromise position that the SALT caucus can live with that the rest of the conference, many of whom are actually skeptical of SALT deductions, can also live with? One possibility that seems to be floated, including even by Speaker of the House Johnson recently, was we know the cap is expiring at the end of 2025. Maybe we extend it, but we make it more generous than it is currently. So there's a few options there. One example is currently the deduction is $10,000 regardless of your filing status. So you could double it for joint households, so there's not that marriage penalty, for example. You could make the whole deduction more generous and double it for joint filers. That would reduce the impact on a lot of households in these districts while not completely getting rid of the entire cap. And that would bring in some additional revenue to help offset these other tax cuts. So there's an equilibrium there, but it's always, of course, a big question whether or not that's a compromise everyone's willing to live with. And one, of course, big question was SALT was actually going to be potentially on the table as going even further and eliminating the entire deduction as a possible offset. Folks were talking about that as recently as this fall prior to the election. But I think given the electoral result, that option is likely off the table.
For sure. I'm with you, Garrett, that I was looking back at the tax cut, the 2017 vote, and there were 12 no votes on it by Republicans, almost all about taxes. And it's going to be a much smaller margin than that for sure. We're almost out of time, but one other thing that's really important for our audience is the federal corporate tax rate. Would love to get your thoughts there. One thing that's interesting to me about it is kind of Trump's journey on it. He first was kind of for taking it from 21% to 20%. And he actually talked behind closed doors about how 15% might be too big of a lift. By the end of the campaign, he was standing in front of a banner that said 15%. Curious kind of what your sense of the impacts of different cuts would be there on the economy overall and sort of business activity.
So we found in our estimates at Tax Foundation that the corporate rate is one of the more damaging ways to raise revenue. And so getting us in a more competitive position, bring it down to 21% in 17 was the right move. And there's some opportunity potentially to trim it further if we want to be even more competitive. Of course, it's got to fit into the context of this revenue situation. And the other wild card or twist here is President-elect Trump has talked about providing that tax cut to 15% for corporations who invest domestically. And so that'd be a little bit of a design difference from the general corporate rate change in 2017. One ambiguity is whether or not that would work more like the old deduction for domestic activity that we used to have under the corporate rate, or if it would be only restricting that corporate rate cut for domestic corporations, and multinationals, for example, would get none of it. So that's something that would, of course, change the revenue costs and the incentives moving forward. I think the big question is, does that fit into the other priorities, including other pro-growth provisions like making bonus depreciation and expensing permanent as well and bringing that back, which has support on a bipartisan basis.
So put away the 15% banner? Is that what you're saying, Garrett?
I think there will still definitely be champions on that in Congress. I think Republicans do want to see that rate go up down. We're about average right now across the industrialized world. So that could be a possibility. It's just a matter of making that math work. The other thing is they may want to try to make that permanent if they did it. And that would require other offsets to get it through the Senate. So I wouldn't put it away quite yet.
Good.
Okay, all of this should make 2025 an interesting one, right? Garrett Watson, thank you so much for joining us today. That does it for Capital Gains here. Our thanks to Garrett, Ben, and Rick as well. And to you for joining. Make sure to like and subscribe to Capital Gains wherever you get your podcasts. We'll be right back here next week.